What's up, everybody? My name is Joe Brown. This is the Heresy Financial Show, and it looks like the Federal Reserve may already be indicating that they are ready to turn on a dime should they need to. We know right now they are battling inflation. They're battling for their lives right now, actually, because if the dollar were to go into hyperinflation and the dollar were to collapse and stop being used as a global reserve currency, we know that the Federal Reserve is done, right? That's their main job, is making sure that the dollar has value and that the world keeps on using it. And so we are right now seeing them fight inflation, which means they are going through QT, quantitative tightening, selling assets off their balance sheet. But it just looks like we got our first signal of a potential turnaround in the future. We got Fed's Bullard, James Bullard. He is the president of the Federal Reserve Bank of St. Louis, saying that we don't have as far to go on QT as it might seem. And so today we are going to break down exactly what he said and why and what that might signal for the future. Ready? Let's dive in. Today's sponsor is Masterworks. With all these signs of recession everywhere, I've been thinking about wealth preservation and diversification, and it seems that I'm not alone. Franklin Templeton Investment Solutions states that more and more investors are looking for protection and inflation hedges, and it's driving them into alternative assets. This is because to achieve diversification, you want uncorrelated assets, assets whose performance is not correlated to the stock market and to the bond market. This helps with reducing overall volatility in your portfolio. When considering the risk-return perspective, one of the most interesting assets inside this asset class is contemporary art. This market has outpaced the S&P 500 by 164% over the last 21 years. And it has shown even stronger performance when inflation is above 3%. And on top of that, even during times of monetary tightening. This is why Forbes reported that an art collection has the potential to rival the long-term returns of bonds. Masterworks is making investing in art accessible to everybody by acquiring multi-million-dollar paintings by blue chip artists such as Picasso, Basquiat, Banksy, and they securitize them, allowing investors to purchase shares, fractional ownership of multi-million-dollar pieces of art. They've developed data-driven strategies and valuation methods, find artworks with the greatest potential for capital appreciation, acquiring only 2% of the art they are offered. After acquiring that artwork, Masterworks then files it as a public offering with the SEC, allowing investors to invest in a portion of that painting. Since inception, Masterworks has sold 3 paintings, each returning over 30% IRR to investors. And although past performance is no guarantee of future results, as you all know, I think this concept is super innovative, and I'm not alone because over 450,000 people have signed up for Masterworks today. And there's a wait list to get started. However, if you would like to skip the wait list, you can use my link in the description below and get started with Masterworks today. James Bullard is the president of the St. Louis Fed, and he was recently talking on the economy here. There's this video, it's an hour and 37 minutes long from the Barcelona School of Economics here. And you can see he was just going through this PowerPoint presentation here, which I found the PDF of, and I will link this in the description below. But it is basically just about what the Federal Reserve is doing right now in light of what is going on in the economy. And in this talk, he stated, we do not have to go as far on QT as it might seem. So very basically, let me give you a background on what is going on here. Over the last 2.5 years, the total monetary supply has expanded rapidly through the Federal Reserve doing 2 things. One of them is quantitative easing, and one of them is lowering interest rates. And so these are 2 tools that expand the monetary supply. How does that happen? Well, let's go with lowering interest rates first. This one makes sense, right? Because if all interest rates get lower, that's going to stimulate borrowing because anybody out there can borrow for much cheaper. So I'm going to borrow extra money. I'm going to go spend that. When money is borrowed, that money is loaned into existence. So when you go to the bank, you borrow money for a mortgage, for a car loan. When you swipe that credit card, that is not money that's being transferred from one account to another. It's not like Aunt Sally has her short-term money in a CD, and that's the only amount of money the bank can use to go lend out to somebody else. No, that money that you borrow is lent into existence. It did not exist before that loan was created. So as interest rates go lower, that stimulates the demand for borrowing because money is cheap. It's easy to get. So people borrow and they spend. Now, some people spend it on stocks through margin and other loans. Some people spend it on expanding their business. Some people spend it on hiring. Some people spend it on luxuries and consumable goods. But whatever it is spent on, lower interest rates in general will stimulate spending and stimulate that spending from borrowing, which expands the money supply. So that's one mechanism the Federal Reserve has used over the last couple of years to increase the money supply. The second is quantitative easing. So very basically, quantitative easing is buying assets. So when you go buy something, let's say in your brokerage account, you have cash in there, you can give that cash to somebody else and get shares of stock in its place. Well, that cash then goes to whoever you bought that share of that stock from, and they can go spend that cash however they want, right? It's the exact same thing with the Federal Reserve's balance sheet. The Federal Reserve has their balance sheet, which is basically like their brokerage account, and they can spend money and buy assets from other people in the market, from other market participants. They can buy mortgage-backed securities, or they can buy treasuries, U.S. treasuries, which are loans to the U.S. government. Now, the only difference between them and us, like our brokerage account, is that when they spend money, they create that money into existence at the time that they spend that money. So they just print money. They just, with a couple of keystrokes, they create money out of thin air, credit it to somebody else's account, and then they get the asset in its place. So that'd be like you having an unlimited margin feature with 0% and no margin callability on your brokerage account. You could buy an unlimited number of stocks out there, and you're just creating that money out of thin air. There's no restraint on how much you can buy. Now, all that money then goes out to whoever sold those assets to the Fed, and then those institutions can go and spend that money where they want. So the Federal Reserve is able to increase the amount of money circulating through the economy through both of those levers. Lowering interest rates so that people will borrow more, and then quantitative easing, which is exchanging cash for assets into the economy so that there's more cash floating around that will go out and buy up other things. So those are the two things that have been happening over the last couple of years that they've had to reverse course on because it's caused inflation, right? If you have, let's say, $1 billion worth of stuff in an economy, and then you print a bunch of money, that's going to make that stuff worth a lot more than $1 billion. And here's how. If all the stuff that you measure in the economy that can possibly be bought or sold is worth $1 billion, and then all the people have a set amount of money. Well, if the Federal Reserve goes and gives everybody more money, so now there's, let's say they give one person $1 billion more. Well, then you'd think that person could then go buy everything in the economy, right? So they'd start trying to buy stuff. But everybody else has money too. And so when you expand the money supply, that money starts to bid up the prices of goods and services like a big auction, because now you have new demand entering from that increased amount of money, but you didn't have new stuff get created. And so you have a flood of buying, a flood of demand from the new money that just entered the system, but the same amount of stuff. That means the prices get lifted up. And so the Federal Reserve, for some reason, was caught off guard by this, even though they've been saying for years that their express goal is to cause inflation, and they printed money to stop the deflation, which is pushing prices up from where they would be otherwise. They were somehow surprised at the amount of inflation that they caused by increasing the money supply by 30 or 40% within a short amount of time. So they've since then, over this last couple of months, they've started quantitative tightening and raising interest rates. So these are the opposite levers. And so when you raise interest rates, that causes money to get paid off, that debt to get paid off. Well, just as that money was loaned into existence, when that debt is paid off, that money ceases to exist. Because in order for me to get money, I have to go be productive, I have to save, and then I have a surplus this month, I've got $1,000 left over, I take that and I go pay off that debt. That money is no longer in circulation anymore. It was in circulation before, and then my boss paid it to me in my paycheck, and I took it from my paycheck and gave it to the bank. That loan ceases to exist, those dollars cease to exist. So when interest rates start to go up, people can't afford that debt anymore, so they have to start paying it off, or people can't afford to pay the debt, so it gets defaulted on. Whatever the mechanism is, when those loans get paid off or when they get defaulted on, when people stop borrowing as much, when they just start paying off more, when that debt service cost goes up, that interest rate goes up, so more of your paycheck just has to go to pay that minimum interest payment. All those things take money out of circulation. Those are deflationary forces. What about the other tool that the Federal Reserve is using? Quantitative tightening, QT. This is selling assets. So remember, if you've got a brokerage account, you sell a stock, what do you get in return? You get dollars. Same thing for the Federal Reserve. When they sell a treasury or when they sell a mortgage-backed security, what do they get in return? Dollars. And so every dollar worth of asset that comes off their balance sheet is exchanged for a dollar that goes onto their balance sheet. But again, they're not reliant on those dollars. They just cease to exist when that happens because they're the ones who have the monopoly on the creation of money. And so all those dollars get sucked out of circulation. It's not like the Federal Reserve is using those dollars to pay their own bills. That's not how it works. And so all those dollars get sucked out of circulation. So we've got two forces right now that are actively combating prices going up. Now, the way that this works its way throughout the economy is something known as the Kantian Effect, and that is how this affects asset prices first, then it affects the prices of goods and services, then it affects the prices of wages. And so when it hits asset prices first, we've seen that for 6 months now. It's been absolute carnage, right? The stock market has been falling. Bond prices have been falling. Crypto has been collapsing. Really, the only thing that hasn't collapsed this year is the price of gold. It's up about 2% year to date, and that's pretty much the only thing that hasn't crashed this year. And so we saw it hit asset prices already. The next place for that to hit, that deflation to hit, is the prices of goods and services. And so when the Federal Reserve's president of the St. Louis Fed says we don't have to go as far on QT as it might seem, number one, he's probably trying to brace the market for the fact that the Federal Reserve might have to turn around quickly. He's probably not aware of the reality of the boom bust cycle, probably not aware of the fact that they're doing a rug pull right now and they're going to cause some major deflationary forces to hit all at once because monetary policy takes time to filter throughout the economy. So we are seeing major deflationary forces hit the economy from all angles. We're already in a recession right now, at least that's my expectation, that when the numbers for GDP for the second quarter come out, that we're already going to be in a recession here. So he's probably not aware of all of that, but he probably is aware that in general, they have to reverse course. And so we're going to start to see this little verbiage here and there from people at the Federal Reserve saying, hey, we're fighting inflation, but we're going to monitor incoming data and we're going to change our course of action if necessary. Because while they do need to make sure, and this is what I alluded to at the very beginning of the video, while they do need to make sure that we don't tip over into hyperinflation, because then it's game over. It's end game for them. They don't have any recovery from that. The Federal Reserve's job is stable prices and full employment, and stable prices are on top of full employment. That's their number one mandate, even if they're not verbally specified that way. They need to make sure that they maintain the value of the currency. Otherwise, they're done. They're gone. They're over. And so they want to make sure that the dollar stays as a global reserve currency. They want to make sure that we don't have hyperinflation. They want to make sure that the entire world doesn't de-dollarize overnight. They want to make sure that everybody still uses the dollar because ultimately that's where the power of the American empire comes from. The fact that countries, central banks, institutions, and especially the American military continues to take payment in dollars. If that goes away, the power is gone overnight. It is done. It's game over. There's no coming back from that. So the Federal Reserve understands that. At the same time, politically, it is very difficult to go through deflation. It's much easier to handle inflation politically than it is to handle deflation, because deflation shows up with much stronger and faster and more acute pain, even though that is the cure for the recession. It's the cure for the malinvestment. It's the cure for everything that has gone wrong. It allows what's supposed to crumble, what is supposed to fail, and allows the incentives in the system to realign so that people save and invest in production conservatively and start to rebuild that savings pool, even though that's the correct course of action, it is much more painful short term than something like inflation. Something like inflation takes longer. It is more politically expedient. You can benefit the borrowers instead of the lenders, which the US government and major institutions, big corporations, they're all borrowers, and so you keep the power where you want to keep it politically for much longer if you favor inflation. And that's why when you look at central banks throughout history, most of the time, if they're going to make an error because they're walking a tightrope here with hyperinflation on one side and a deflationary death spiral on the other side, you see many times if they're going to make an error, they accidentally tip over into hyperinflation. Not very often do they tip over into deflation on accident. Normally, more often than not, when they make an error to the inflation side. So that's my expectation, that they're going to be watching this very closely. And while they do know they need to fight deflation, Federal Reserve is going to be starting to drop these little hints like Bullard just dropped, that we don't have to go as far on QT as it might seem. And that is true because we already have these deflationary forces hitting, and they need to make sure that everybody's prepared for them to stop QT and maybe even start up QE again in order to make sure that we don't get a deflationary death spiral, the American government bankrupting on their debt, things like that. Those are the things that politically they want to avoid. But you let me know what you think. How long will it be before we see the Federal Reserve reverse course? How long do you think they'll be able to continue quantitative tightening, continue raising interest rates before it gets to the point where they signal, hey, we're reversing course and firing up the inflation machine once again? As always, I really appreciate you guys. Thank you so much for watching. Have a great day.